Down on the session, down on the week. Live from New York City this morning. Good morning, good morning. Your equity market's softer here. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Fed officials insisting there's more work to do. The president taking digs at China's economy as a new era of labor power puts Detroit on notice. We begin with the big issue. Too early for a victory lap.
There is some fear of a reacceleration.
Reacceleration in inflation.
I see more inflation as we head into the back half of the year.
The second half of the year.
The end of the year and sometime next year.
In 2024.
Timing is always difficult.
This is going to be a roller coaster.
Inflation is going to have a hard time hitting its 2% target.
We got a long ways to go before we get to 2%.
The economy is growing above trend.
You really need to see signs of broader economic moderation.
I don't think the Fed has done enough.
We may have another rate hike. The door's open for a hike in November.
The Fed is kind of enamored with this soft landing view.
The Fed could screw this up.
There is a risk that the Fed is kind of patting itself on the back by the end of the year, only to watch inflation potentially turn back up.
Joining us now to discuss, Invesco's Brian Levitt, Kathy Jones of Charles Schwab. Kathy, straight to you. Is there reason to believe this Fed is done?
Yeah, I think there's a lot of reasons to believe the Fed is done. Despite the worries about reacceleration in inflation, we're just not seeing very much of that. Now we've got the energy issue, but where is that reacceleration going to come from? We have moderating growth. We have the unemployment, is low, but starting to edge up. Wage increases are starting to moderate. You can't get it through the credit channel because credit is tight and tightening. And globally, we've got, some real weakness coming out of China and Europe. So I'm wondering where this big reacceleration in inflation is going to come from outside of perhaps energy.
So here's the challenge. Comes from Larry McDonald and on Twitter moments ago. This is what he had to say. U.S. government spending up 10% year over year. Labor unions carrying the most power in decades. A resilient U.S. economy. And the Saudi kingdom aggressively cutting oil production into record demand. He says all of that not deflationary. Brian, what do you say?
Well, I'd start with the energy comments. I mean, the energy will be a tax on the U.S. consumer. And so part of what we've been waiting to see in all of this is for the consumer to moderate. So that would be one thing. I agree with really everything that Kathy had to say. It's an economy that is going to moderate in the coming quarters. We still haven't seen the lagged effects of all this policy tightening. And to think that this time is significantly different, I would disagree. The way these things almost always play out is, the Fed tightens significantly, inflation peaks and comes down, the markets rally, and people don't believe that inflation is really done. And typically what you find is the banks start to tighten the lending standards, economy slows more, and the inflation story becomes completely passé. So that's where I am. I know on a basis effect, you're going to have some pickup on a year-over-year basis just because of some months rolling off, but that's not what I'm focused on. I want to see the month over month, and the last report was 0.2%. You annualize that, you're very much within the Fed's comfort zone. So that's what I'll be watching, and I think that this is an overblown risk.
A tiny upside surprise on PPI 33 minutes ago. Brian, this is what Neil Dutta of Renmax got to say. I think the bigger issue for the market is that it sees core producer prices bottoming. We know freight rates are bottoming, and we know that oil prices are climbing. He goes on to say risks are building, that the Fed has more work to do. One question, Brian, that Neil has asked, and I'll ask that question of you. How is 3.5% unemployment consistent with inflation returning to 2%? What's the answer to that, Brian?
Well, it's a lagging indicator. And, we've always talked about how long it takes for a policy to work its way through the system. And quite frankly, it may just be going a little bit slower right now because we all locked in fixed rates, all of us, including homeowners and businesses, and push maturities well out in the future. But it will continue. It will ultimately bite. And you've seen some signs of some weakness in the job market, or weakening in the job market. So this will play out. I think it's I think it's a challenge to say it's different this time. I think in every cycle, we you can go back to the early 1980s and not be convinced that inflation was broken, and ultimately it was. So you'll see the unemployment rate tick up as the economy rolls over next year, and that'll set the backdrop, in my opinion, for the Federal Reserve to be with a full shift in stance in 2024.
Kathy, do you agree with that?
Yeah, I agree with Brian. I do think the Fed will be focused mostly on the growth numbers going forward. I think they're pretty satisfied that when you look at the numbers, they've pretty much achieved their inflation target, and it will continue to roll over. I think what they really are looking at, though, are the growth numbers to see if they can maintain this low inflation that's coming through. So that's the risk to Fed policy going forward. I think that they're still very much focused on coincident indicators, maybe lagging indicators instead of leading indicators, and those are pointing to still some firmness in the economy. But I don't think that they'll be hiking again. I think that in 2024, to some point, we will see some rate cuts.
Stocks rolling over this morning. We're down by 0.3% on the S&P 500. Treasuries lower as well. Yields are higher on a 10-year by 3 basis points. On a 2-year by 4.88 on a 2-year. CPI out yesterday, PPI this morning. Let's put it together and catch up with Bloomberg's Ed Harrison. Ed, wonderful to catch up with you, buddy, as always. What's the takeaway for you from CPI yesterday, PPI this morning?
I think the takeaway is that all of the disinflation is bottoming, and we have to look to services in the core to see whether or not we're going to get to 2% anytime soon. So there is work to be done if the Fed wants to go to 2%. There's less work to be done potentially if they don't want to go to 2%.
Ed, we've got two guests here, Brian and Kathy, talking up the end of the hiking cycle and the potential for rate cuts in early 2024. What's the pushback, Ed, against that?
Yeah, I think the pushback is that we're not going to get to 2% anytime soon on core services. And so the question is how hawkish is the Fed given the data that we've seen come out? And I think that there's a cohort of people at the Fed who are saying that, we actually want to hike maybe 1 or 2 more times. We saw Mary Daly saying that there's still work to be done just earlier this week. And, she's considered to be neutral to dovish. And then once we get to that level, they've said consistently, at least for a year, that they're not going to cut. And you'd have to see the labor market back up considerably in order for them to actually cut. So it's more likely that they're going to hike and hold than it is that they're going to hold and cut.
Ed Harrison on the latest. Ed, wonderful to catch up with you out of DC on CPI yesterday and PPI this morning. Ed mentioned Mary Daly of the San Francisco Fed. This is what she said to Yahoo Finance. It is not a data point that says victory is ours. Speaking of CPI out yesterday, there's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% inflation target. Brian, you heard what Ed just said then. If you're looking for cuts in early 2024, where do you anticipate the labour market is at that point?
Well, I would say the market's telling us more out towards like mid-2024. So my view is that the economy starts to slow in 2024, and then you'll see the Fed pivot. The good news is that, the labor market doesn't have to break significantly. We had a period where we were short of workers, and so businesses are unlikely to be removing workers significantly, and that's how you start to get a better feel in this than what you've had in past cycles. Investors are so used to in 08, 2020, it doesn't have to be as catastrophic at that. But a lot of talk about the core services, and a lot of talk about service inflation, and things that I'm not hearing mentioned is how soft the apartment rental market is. You've seen a collapse in money supply. You have businesses that have rebuilt inventory pretty significantly on the goods side. So all of this feels disinflationary to me. And if you look at what the bond market is telling us, at least in the break evens, there's not a lot of concern in the bond market that the Fed has lost control of inflation or that inflation's not returning to the 2% comfort zone. So I don't think it has to be 2. I think that we're 2 to 3% comfort zone with an economy rolling over, has the Federal Reserve proceeding with caution.
So, Brian, you and Kathy are both on the same page here. This Fed might be done. Rate cuts might be coming early next year. There's a difference, though, in the market call. I've been going through the notes overnight. Kathy believes this is the moment for duration, not for credit risk. Brian, you believe this is the moment for cyclicals in the equity market. So, Brian, you've got to explain that one. If you're expecting a Fed to be cutting because the economy's not doing so well and inflation's coming down, why do I want to buy cyclicals right now?
Well, there's a moment in time where the market is gonna have a nice trade over the course of this year. So our view is that you're going to continue to move higher this year. The economy is going to remain resilient, and we're going to get better comments out of the Fed, more of a sign of a shift that that the end of the tightening is here. So that's more of a risk-on backdrop between now and the end of the year, more of a cyclical feel. The economy rolls over. Next year, you'll probably get more of a contraction, more of a defensive type of trade. But ultimately, if we're right and the Federal Reserve starts to back off the tightening stance, well, then that's the beginning of the new cycle. And the market will start to look ahead to that. And so tactically, you may be risk on to hear the end of the year, maybe give back a little that as the economy rolls over. But if you don't want to be so tactical and you're thinking about how new cycles emerge, well, they tend to emerge with the Federal Reserve backing off the tightening cycle and ultimately easing. And that's when you want to be exposed to risk assets and more exposed to credit and more exposed to early cyclicals.
Kathy, we teed you up here. Why is now the moment for the opposite, duration over credit risk?
Yeah, our concern is in the credit markets that we're still in a tightening mode. Not only is the Fed still, holding rates at very high real levels, but they're shrinking the balance sheet. And it's not really reflected very well in credit spreads. The risk, particularly in, say, the high yield market, at under 400 over is just not giving you a lot of reward for taking the risk into a slowing economy. And we know that a lot of the borrowers have termed out their debt and the maturity wall is still a year away. But that's not really a steamroller we want to step in front of in a big way. We'd rather get more risk premium if we're going to take if we can take that risk. And it's just not really reflected there. And so given all the tightening that's in the pipeline, given the lending problems that we're seeing in the banking sector, our concern is the credit markets just aren't giving you enough on a risk-reward basis.
Kathy, Brian, stick with us. Slight tweak from Bank of America and a team led by Mike Gapin. The story just dropped in my inbox. Their note, the title, When Doves Fly. The first few bullet points, I'll share them with you. We tweak our Fed call, shifting the last hike from September, pushing it out to November. The main drivers of the change are the benign July CPI report and dovish Fed speak. I think they're leaning towards the Williams speak more than maybe the daily speak. Upside risk to food and energy prices and a resilient economy keep the last hike on the table. But Gapin and the team saying it's a close call. The latest from Bank of America just moments ago. Let's get you some movers going into the opening bell. Here's Abby.
Big tech stocks, John, are also saying it's a close call because we, of course, do have yields up a little bit today on that PPI. And big tech is down. In fact, the NASDAQ 100, if its current losses hold, will fall 5% on the week or thereabouts. So a pretty rough week, a second down week in a row. NVIDIA yet to report, down 1.5%. Will the AI hype show up in their numbers? Tesla down 1.2% as a China competitor is cutting prices. And then Apple, not down a lot, John, but down 0.3%. If this loss holds, it will be an 8th out of 9 days, the worst stretch since last year, of course, on slowing growth concerns. Plus, as yields are higher, of course, the valuation for these big tech stocks really comes into question.
Abby, thank you. More from Abby around the opening bell. Coming up, China's economy showing further signs of weakening.
I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that.
China's new loans plunging to the lowest level since 2009. That conversation up next.
I think the China stimulus narrative is one that the markets have really loved and embraced, and we're getting a bit of a reality check on that. As it relates to commodity prices, all of this news of stimulus has certainly pushed them up, pushed inflation expectations higher, and that's become a big problem for the Fed here, who certainly has not yet claimed victory on inflation.
Emily Rowland of John Hancock on the implications of a weaker Chinese economy. More cracks emerging, with new loans from Chinese banks in July falling to the lowest level since 2009. President Biden adding insult to injury, calling China a ticking time bomb and adding, quote, "That's not good, because when bad folks have problems, they do bad things." Let's get to team coverage now with Bloomberg's Kelly Lyons and Tom Orlick out of Washington. Kaylee, what did the president mean by that?
Well, he was essentially poking at China's economy, John, but in doing so, he also said a few things that are just simply factually inaccurate. He was talking about how they have a higher number of people of retirement age than working age. That statement not only is untrue, it's off by hundreds of millions of people. He also said China has gone from growing 8% a year to 2%. China grew 5.5% in the first half. So he was saying some things that were untrue, but definitely sharp criticism of China's economy at a time in which the economic conversation around China for Beijing is likely highly sensitive. I know Tom will run through more on what is going on in the economy and some of the fragilities of it, but it could be poking the bear a little bit here, especially at a time in which President Biden and his administration are trying to stabilize ties with Beijing. We have seen something like this happen before, John. If you recall back in June, also at a donor event, Biden referred to Chinese President Xi Jinping as a dictator in the almost immediate aftermath of Secretary of State Antony Blinken returning from a trip to Beijing, attempting to normalize relations. Of course, since then, we have seen other officials traveling to Beijing. U.S. Treasury Secretary Janet Yellen made a trip, as did climate envoy John Kerry. We're expecting Commerce Secretary Gina Raimondo to do the same. But this still could be disruptive in this relationship and could make it more difficult, perhaps, the proposition for President Biden to meet in person with Xi Jinping this fall, considering not only he is making remarks like a ticking time bomb, but also the U.S. is taking active action to restrict China's advancement of certain technologies, like the executive order on outbound investment the president signed earlier this week.
Audience matters. It was two donors, and you can only imagine, draw the conclusion that this is what donors want to hear right now from American politicians. Yeah. Tom, on Wall Street, we're focused on the data. The information we're getting from the economy this week, not great. Tom, just how bad things are they?
So first of all, Jonathan, I've just got to pick up on one comment from Kaylee. As this is China, we're not actually poking the bear in general. We're specifically poking the panda. But coming to the data, I think Biden was wrong on the specifics of the numbers he used, but in spirit, he hit the right point. There are some serious problems in China right now. We're having defaults by some really big property developers. Household wealth is tied up in property. Property is the biggest driver of growth in the economy. And so, of course, when property goes down, confidence slumps, and we're now seeing that playing out in a big hit to the credit data. Now, keep in mind here that credit data is bumpy, volatile, seasonal, so we'll want to look at a few more months before we draw a firm conclusion. But clearly, a really, really big miss on the loan data for July is not what China's policymakers want to see right now. Our expectation is that the response, it's not going to be shock and awe stimulus. They don't have the firepower to do that. But we expect more with a steady drumbeat of pro-growth measures in the months ahead.
Tom Orlick, Kelly Lyons, two of the very best down in Washington, D.C. To the both of you, thank you. Brian Levitt, Kathy Jones, back with us for a final word on this. Kathy, when you see data like that, like the data we had out of China this morning, what did you think?
Yeah, it's surprisingly weak. I mean, we knew it was going to be soft, but surprisingly weak. And it tells me that we're on a trajectory here globally that you really aren't going to get a lot of stimulus, a lot of economic impulse coming out of the global economy anytime soon. So that, combined with what we've seen out of Europe recently, tells us that we're just in a very slow growth world for the time being.
Kathy, typically if we woke up, let's say 8 years ago, to data like this in China, new loan growth at the lowest since 2009 from Chinese banks, a property developer trading like a penny stock, it is a penny stock, over in Hong Kong. Brian, these were all things that used to drive massive bond market rallies, big commodity market sell-offs. Brian, why do we feel a little bit more comfortable with this drip feed of negative data out of the world's second largest economy? Where does that comfort come from?
Yeah, I mean, you've seen a pretty resilient U.S. economy. So there's some comfort in the resiliency of the U.S. economy and the lack of leverage in the U.S. economy and the general strength that's been persisted by the U.S. consumer. But I agree with Kathy on this. I mean, this goes back to the point that we were discussing earlier, is that there's not a big catalyst for significant economic growth in the world. And so this move of rates higher, this concern that inflation persists and the Fed's going to have to keep tightening, I think is overstated. It's looking backward. And, you know, the Fed has tightened a lot. China has done some pretty tough regulatory measures a couple of years ago, tough COVID measures last year. So that economy is struggling. And of course, Europe has its challenges. So you point to all of that. It's, we see rates going up in the U.S. today. I just don't think it's sustainable. I think you'll see rates back down, and that'll start to lead to more risk taking again in the United States, because the U.S. becomes a place where growth is reasonable and the Federal Reserve can start to pivot.
Brian, Kathy, to the two of you, thank you. Have a good weekend. It's good to catch up. The opening bell about 7 or 8 minutes away. Equity futures lower here by 1/3 of 1%. Brian referenced that bond market sell-off. A bit softer this morning. The Treasury market down. Yields up by 5 basis points on a 2-year. 4.89 on a 10-year here by 3 or 4 basis points to about 4.14. I believe this is the 4th week of 10-year yields climbing higher in the Treasury market. Coming up, the morning calls, and later we'll catch up with TPW's Jay Paloski around the opening bell. Your opening bell, 7 minutes away. Five minutes away from the opening bell. Stocks lower here across the board on the S&P. On the Nasdaq, on a Russell as well. That's the price action. Here's some morning calls. First up, Wolf Research downgrading Stanley Black & Decker to underperform, pointing to margin headwinds and an unattractive valuation. That stock is down by 1.5% to 93.86. Your second call from Citi, opening an upside catalyst watch on Cisco, whatever that means, expecting strong enterprise demand to fuel better than estimated results next week. That stock is just about unchanged at 53.35. And your third and final call this morning from Redburn, raising its Amazon price target up to $230, expecting shares to rally as revenue growth starts accelerating. That stock is negative by 0.8%. The retailers come next week, remember. That's going to be the earnings story for Wednesday and Thursday. Target on Wednesday, I believe. Walmart next Thursday. Coming up on this program today, a new era of Labour power putting Detroit on notice. We'll catch up with Jay Paloski of TPW. That opening bell just around the corner. .24 seconds away from the opening bell here, down across the board. On the Nasdaq, we're down by 3/4 of 1% on the session. On the week, we're lower as well. On the week, I've had to check this stat about 5 different times already. We are poised for the first back-to-back weekly loss on the Nasdaq 100 of the year so far. That's your opening bell. Switch to the board and get to the bond market. Yields shaping up as follows on a 10-year, higher by 4 or 5 basis points. PPI with the softest of upside surprises, enough to generate a lift in yields here, particularly following the weakness we saw yesterday afternoon in the Treasury market, following that soft 30-year auction. 3-year was okay, 10-year was decent. The 30-year supply didn't go as well. Yields up and away. In the FX market, the dollar stronger off the back of that PPI report. The euro negative by 0.15%, 109.65, and crude just a touch lower here by 11 cents. We're down by 1/10 of 1% to $82.71. About 30 seconds into the session, your equity market is lower by 0.5 of 1% on the S&P, down by about 0.8%. 3/4 of 1% lower on the Nasdaq. One stock to watch at the open, Virgin Galactic. Shares moving higher after announcing plans for the next space tourism mission. The launch is on track for 1 month from now. Abby has more. Hey, Abby.
Hey, John. And folks have been waiting for this possibility for almost 2 decades. This company, of course, was founded in 2004 and talked about these space tourist flights happening as early as 2007. There's been a lot of incidents in between, including one tragic crash back in 2014. But we did have a successful launch, and we had space tourists going to the edge of space yesterday. Now, it's interesting. The stock over the last 8 days into today down, the longest losing streak since 2021. Today up a measly 0.6%. You would think that on this sort of a milestone that the stock would be up much more. The stock, in fact, is down 94% from its 2021 peak. It has everything to do with the numbers. There's minuscule revenue that they are making. There's a huge backlog, I believe 800 folks who want to fly into space. So they really have their work cut out for them. Deeply unprofitable, an 18.5% short interest. So yes, we had this great milestone yesterday for space, but they're also competing against Jeff Bezos's Blue Origin. Again, this company really has its work cut out for them.
Who goes highest, Abby? Do they actually go to space or not?
You know, the edge of space, I'm not sure if I count that as space, but I'm also not an expert on it, so.
Kind of there. Abby, thank you. Turning to financials, UBS ending its $10 billion backstop agreement with the Swiss government to cover potential losses from its takeover of Credit Suisse. The CEO, Sergio Ermotti, calling it, quote, a testimony to the strength of UBS. Katie has the story. Hey, Katie.
Hey, John. Yeah, UBS top brass taking a little bit of a victory lap this morning after voluntarily terminating that loss protection agreement with the Swiss government. That decision came after stress testing a portfolio of Credit Suisse non-core assets. UBS also said that it will terminate a liquidity backstop with the Swiss National Bank of up to 100 billion francs. Now, these support measures, of course, had smoothed over that shotgun wedding between UBS and Credit Suisse, of course, officiated by the Swiss government. And taken together, the end of these support measures suggests that not only is the integration of these two banks on track, but that Credit Suisse's assets might be less troublesome than initially thought. Not everyone is thrilled about this. John, Bloomberg News reporting in the last hour or so that the Credit Suisse AT1 bondholders who were wiped out are unhappy with these moves. This is according to people familiar, arguing that basically the end of these backstops means that the write-down of those AT1s was unnecessary. We'll see how that develops.
Katie, thank you for that. They've been unhappy for the last 5 months, and for good reason. Another media company reporting results, News Corp, posting a 75% drop in annual profits. The CEO hinting at an AI-driven future, saying, quote, we believe generative AI presents a remarkable opportunity to create a new stream of revenues while allowing us to reduce costs across the business. Simone has more. Hey, Simone.
Hey, John. Yeah, traders trying to figure out exactly what's going on here. Shares were down a little bit in the pre-market. Now they're in the green. Revenue missing estimates. Revenue $2.43 billion for the fourth quarter. We heard that yesterday, down 9% year on year. Analysts were looking for something closer to 2.5 and sliding across all different segments. But if you were looking for something positive, the message was clearly there in the digital side. Digital accounting for over 50% of News Corp revenue for the full year. For the very first time, Dow Jones also seeing its highest profit ever. BI says this is a bright spot, accounting for 22% of revenue during the year. We heard that mention of generative AI. The one place that's not so positive, though, the book publishing segment, Bloomberg Intelligence says that's in free fall. The company also saying Simon & Schuster just wasn't a good enough deal for them, and that's why they didn't push in there, John.
Simone, thank you. That stock just inching a little bit higher, trying to bounce. Let's turn to autos. This, for me, the story of the last 24 hours within the equity market. GM and Ford looking to avoid a fourth day of losses amid growing concerns that union negotiations could send their labour costs absolutely soaring. Analysts at Morningstar warning the stocks could be in the penalty box for a while. David Welch out of Detroit joins us now. David, just run us through what this union boss is asking for.
He's sort of given the automakers a laundry list of just about everything the union could ask for. He wants to claw back anything and everything that union auto workers made concessions over since 2007. Recall back then, Nation and the car companies heading into the financial crisis. General Motors and Chrysler eventually went bankrupt, and they agreed to lower wages for starting workers. They gave up defined benefit pensions in favor of 401k for new hires. Workers didn't get a raise for a very long time, even those who were at the top $32 an hour wage. There were other things like cost of living allowances. All that stuff went away. So he wants cost of living allowance, some sort of inflation protection back. He wants raises for workers, and I think the companies are very willing to give in on that. The things that they won't touch, that the union has asked for, and these are very big ticket items, and arguably what pushed General Motors into bankruptcy, were retiree health care guarantees and a defined benefit pension plan. Both of those things were tens of billions of dollars in liabilities that GM couldn't afford at the time they did go bankrupt. Same thing with Chrysler. And the unions asked for that. I'm not sure if the union believes they'll get that. I think pay and reducing the number of workers who are on this kind of sort of entry-level pay scale, I think eliminating that will go a long way. And also securing the compensation for battery plant workers. That's another thing the union wants. I think those will be the issues with the automakers can do something on. But I think the retiree stuff, I don't see them touching and going back to the days when they have those massive liabilities.
David, do you sense that on the other side of town, on the West Coast, you've got Tesla just sitting there smiling, watching this play out in Detroit?
Yeah, and I think Tesla is probably smiling. I think probably Toyota and the Japanese and European automakers who are here and don't have union plants are looking at this and saying, okay, my competitors' labor costs are going to go up one way or the other. And that's really the overhang on the stock is even if you don't have a big strike, and I think we probably will, but even if you don't have a big strike, and even if the union doesn't get these retiree benefits, you're still looking at a more expensive labor contract. It is one the companies can afford because wages just aren't that huge a part of the cost of a vehicle these days, but it's going to be an expensive contract. And if you're looking at companies that don't have a lot of growth and are looking at lower profits, lower prices on electric vehicles right now, this doesn't help them.
What a moment for that industry. David, thank you. TPW Advisory's Jay Paloski weighing in on this race. Here's a quote for you. We're going to have a great conversation in a moment. The traditional winners of the auto race, the Europeans and Japanese, have fallen behind the US and China in the EV race, with potentially dramatic implications for their industrial bases. Jay Paloski joins us now for more. Jay, wonderful to catch up with you, mate. We're going to do something different and focus on this because I know that you and the team over at TPW are laser focused on this one issue. What do you make of these labour negotiations and how do they shape that war in that tripolar world that you often talk about between China, Europe and the US in this industry?
Well, I think the auto industry, John, is kind of at the forefront of what we see as an age of competition, right? That's what we wrote about in our monthly last week. And in the EV space is really the sharp tip of the spear. And that's where the Chinese have taken a leadership role, right, in terms of almost the entire EV, battery, and renewable space. And so Tesla in the U.S. is the U.S. main competitor. GM and Ford are lagging far behind. And then you have the Europeans and the Japanese who have really missed the transition so far from internal combustion to electric battery mobility. And that's really the forefront. And that's kind of the point, John, as we look at the future, the next 3 to 5 years, we see an age of competition between our three main regions of Europe, Asia, and the Americas in an AI age, which means the speed of things are picking up. And what we think this implies for investors, because we always have to bring it back to the markets, obviously, is that we're going to have a shift, and we're just at the beginning of it, from a focus on monetary policy with the Fed and ECB, et cetera, to fiscal policy and a manufacturing revival. And we think the surprise near term for investors in the second half of this year and into 2024 is going to be just that, a manufacturing recovery and a CapEx boom that's going to take place over the next 3 to 5 years, driven by this need to compete. All three regions are highly motivated to compete because you're talking about climate, you're talking about AI. There's not really an excuse for not competing in these spaces.
Jay, how do the likes of GM and Ford compete when they face demands like these? 46% wage increases, restoration of traditional pensions, cost of living increases, shorter work week, better retiree benefits, all things that workers are entitled to ask in a labour market like this one. But Jay, given the argument that you're having, How on earth do those companies compete with what is happening elsewhere?
Well, I think, John, I mean, it's not just, GM and Ford. We have Tesla in the United States, right? And so that's our ace in the hole. The Japanese, the Germans, they don't have anything. So they don't, Toyota, Mitsubishi, it doesn't really matter. And the race is sharpening where in China, BYD and others are basically eating the lunch of the European and Japanese. The Japanese are shutting down production in China, and BYD and others are now making inroads into Europe. And here's the good news for the U.S. is that we have a tariff set up in the Inflation Reduction Act limits producers to producing in the United States if they want subsidies. So how GM and Ford compete is really up to them, right? And so that's an issue for the companies and for the leadership and for the unions to kind of figure out. But from a big picture, tripolar world perspective, the U.S. is in decent shape. And what's kind of interesting when we think about this competition is that the U.S. leads in AI and China leads in climate. And then the second big takeaway we had is that the U.S. is adopting Chinese policy, state-driven, new industrial policy, right? Top-down, public-private sector cooperation, while the Chinese are adopting the U.S. strategy of trying to drive growth through consumer demand and consumption. So the two of the three main players are switching clothes, so to speak. And then you have the Europeans who have sat on the sidelines, content to be rule makers and regulators, and they're realizing that they can't afford to sit in that position. And so just in the last 2 weeks, as an example, switching gears a bit, you've had Germany announce 2 semi-fab plants being set up in Germany as Europe starts to get in the game. Because the other side of the AI is obviously the semi side of things, as well as the EV and climate side.
So, Jay, what I hear from you, just to make it really simple, just the headline here, the US is winning at EVs, thank you, Tesla. China's winning at climate. We know they're producing a load of solar panels and they have the goods to keep on going. Europe's winning at nothing. So, Jay, let's talk about investment opportunities. Where are they? What are they right now?
Yeah, I mean, John, we've been talking about rotation. We wrote about rotation 3 months ago, titled our piece Rotation from Big Tech to Cyclicals in the U.S. That's worked out really, really well. You just talked about NASDAQ being down 2 weeks in a row. We continue to focus on what we're now calling a rolling rotation. And so that rolling rotation, we're going from rate hikes to rate cuts led by the emerging markets. We're going from monetary policy to fiscal policy, focus on manufacturing recovery. So we're really focused on 2 specific areas right now. We continue to be overweight equities, underweight bonds, and overweight commodities. What we like at the moment and where we're focusing our model portfolio work is in emerging markets, both in China. We think China is set up to recover nicely in the second half, definitely counter consensus. We're just added to Chinese tech here in the last week or two. And then in the commodity space, where we're sharpening our edge on energy, as well as in industrial metals, as well as in uranium on the climate side. So we have specific areas that have lagged. Commodities are just breaking out. We think there's significant upside if we're right in our manufacturing, competition, CapEx boom, big upside for EM, big upside for commodities, John.
Jay, got to squeeze it in. You went there with a massive counter-consensus call on China, given the news we've had this week. Deflation, you've seen the loan data. For people just tuning in, get this loan data out of China. Chinese banks extending the smallest amount of monthly loans since 2009 in the month of July. Jay, where's that demand going to come from? Where's that stimulus going to kick in? What does it look like? Where does that constructive view come from for you?
Yeah, no, you're absolutely right, John. It is counter-consensus. The bashing of China is just off the charts, right? It's basically like, our view was that no recession. Our view has been constructive on risk since last year. This is the same thing with China right now. So China's just replaced the recession call as, bash China. It's the easy thing to do. Look, China is suffering from a lack of consumer confidence. It's very clear. Savings are skyrocketing. Same thing as in the U.S. 6 months ago. Money market funds. Everybody wanted to talk about them. Same is happening in China. So we need to see some more constructive policies out of China. One reason why we like tech is that the government has moved away from the tech bashing of the last couple of years. They realize now they're in an AI fight. They have to support their tech space, same in the U.S. So we expect to see continued policy support, not a big bang, not a huge stimulus, because that game is not going to happen in China. Oh, I just lost my lights. So there you go from China. They shut the lights off when you talk bullish on China, John.
You're not allowed, Jay. It's banned. Jay Paloski at TVW. Jay, go and enjoy your weekend. Thank you. Giving us all something to think about there. About 16 minutes into the session, we're down about 0.5% on the S&P 500. On the Nasdaq, we're down by 0.9%. The PPI data about an hour and 15 minutes ago will be blamed for the move, no doubt. Whether you think that should be blamed for the move is up to you. In the bond market, Treasury's down. Yields are higher by 6 basis points on a 2-year. 490 on a 2-year. The 10-year getting back up to 414, up 4 basis points there as well on the 10-year. Remember, in the last 24 hours, just a softer issue at the long end in a 30-year auction yesterday, pushing Treasuries down and yields up. And that move this morning continues, and encouraged by maybe that small, mild upside surprise on PPI. Up next, we're going to wrap up the week. We'll catch up with Mike McKee as Fed officials insist there's more work to do.
The Federal Reserve has a dual mandate from Congress. The first is to foster stable prices. And this is why we have been working hard in recent months to reduce inflation, which has been too high, and bring it back down to our target of 2%.
The team coverage here at Bloomberg continues.
It's also consistent with what we believe will be happening, which is that inflation will gradually make its way down. But it is not a data point that says victory is ours. There's still more work to do, and the Fed is fully committed to resolutely bringing inflation back down to its 2% target.
That was Mary Daly of the San Francisco Fed speaking to Yahoo Finance. Mary Daly and other Fed officials insisting there's more work to do. Despite yesterday's subdued CPI print, President Biden taking a bit of a victory lap and crediting his Inflation Reduction Act, but regressing the name, saying the title doesn't draw enough attention to its impact on the overall economy. This coming ahead of the legislation's 1-year anniversary next week. I want to touch base with Kayleigh Lyons for a final word down in Washington, D.C. Kayleigh, isn't this exactly what the Republicans said a year ago, that it shouldn't be anything to do with inflation?
Well, that's exactly right, because not only is this about, yes, investing in clean energy in the transition, but there were also things related to healthcare and the tax code in this as well. And obviously, this wasn't the most bipartisan bill that has ever gotten through Congress, though the president did manage to get it through there. But it does speak to the fact, John, that he's having difficulty selling it because Americans' perceptions of inflation in the economy just don't necessarily track with progress being made, even though progress is made. That brings us back to what Federal Reserve officials have been saying, even in light of the data we got yesterday. Mary Daly saying there's still more work to do. Raphael Bostic's talking about they still need to get to that 2% goal. Michelle Bowman, of course, earlier this week saying they may need to hike rates further in order to really get price pressures under control. We'll, of course, get more clarity on the Fed's thinking in the minutes next week. But it really ultimately comes down to, for the president, John, what the American people are thinking. Polling consistently shows that there is high disapproval of his handling of the economy. His overall approval ratings remain low because at the end of the day, even if the price or the pace of inflation moving higher is going down, prices are still high for voters, and the president is dealing with that as best he can, but it's not necessarily working in his favor at this point.
Kayleigh, I've got 10 seconds. Why does Mike McKee get a day off for his birthday and you don't?
That is an excellent question, John. You should ask it to management.
Got to figure it out. Kayleigh Lyons, happy birthday. It's good to see you. You enjoy the weekend. Thank you. About 23 minutes into the session, we're down here by 0.5%. Your trading diary up next. The story of the session so far. Data out of China, not great. That's been the story of the week so far. PPI this morning, a mild upside surprise. Treasuries down, yields up, stocks lower. In the equity market right now on the S&P down by 0.4% and a touch more on the Nasdaq. That's the price action. Let's get to the trading diary. UMich Consumer Sentiment Survey, top of the hour. Don't miss that. Looking ahead to next week, US retail sales coming on Tuesday, plus Fed speak from Kashkari and others. We'll get some Fed minutes on Wednesday, some earnings from Target and Walmart through the week, and finally another round of jobless claims. That does it for the next week. That does it for me this week. From New York, thank you for choosing Bloomberg TV. This was the countdown to the Open. Have a wonderful weekend and good luck for the rest of the trading day. This is Bloomberg.